Picture this, it's 1977 and a down-on-his-luck investor named Seth Klarman walks into Wall Street's whirlwind of noise and hype. Everyone's chasing the next hot stock, dreaming of quick millions. But Seth's about to do something almost heretical. He's hunting for bargains where others see risk. What's his secret? A strategy that feels counterintuitive but promises safer bets and bigger payoffs. Let's dive into why value investing, the art of buying cheap with a margin of safety, beats the crowd every single time. Before you buy, you have to understand the split between price and actual worth. It's a deceptively simple gap, one that most investors miss until it's too late. In 1980, Klarman spotted Underwood Mills, a textile company deep in trouble. While Wall Street panicked, he dived into its assets and earning power. The stock was trading well below what the company was really worth, like buying a diamond for the price of glass. That bet eventually paid off handsomely, illustrating his central thesis: price is not value. Imagine buying a house solely by looking at its listing price. The real value depends on the foundation, neighborhood, and potential. Value investing maps that difference. Price is the sign on the door, value is everything inside. That margin of safety, a buffer between the two, is what protects investors when markets turn sideways. Here's where it flips. Waiting for the price to reflect value feels boring, but it turns risk sweet. Instead of gambling on hype, you're relying on discipline and fundamentals. The market hurries ahead on emotion, but patience worms you into owning real assets at bargain prices. This patience is a competitive advantage few embrace. Benjamin Graham's famous phrase sounds like insurance, but it's the heart of surviving market chaos. Let's unpack this lifesaver concept that separates smart investors from gamblers. Back in 1929, Graham taught that buying stocks well below their intrinsic value acts like a safety net. When the crash hit, many lost everything. But those who embraced margin of safety saw their investments survive, often to thrive later. It's not about avoiding losses entirely, it's about limiting how deeply they cut. Think of the margin of safety like a tightrope walker's safety net woven beneath the wire. You don't plan to fall, but if you do, the net catches you before disaster. Investing without that net, that's walking blind over a chasm, hoping you don't slip. Klarman doesn't just echo Graham, he expands it. For him, the real victory isn't chasing big gains but preserving capital first. The moment you lose big, recovery can take decades. So by shifting the goal from winning fast to losing less, you position yourself for long-term success few others can touch. You've seen folks chase fads, buy hot tips, and bet on dreams. Why does Klarman say most of these strategies are just gambling in disguise? Remember the dot-com bubble? Investors piled into flashy stocks based on hype, not value. When the bubble burst, fortunes evaporated overnight. Klarman warns that crowded trades behave like pack animals rushing to the cliff's edge. When one falls, the rest follow. Herd behavior isn't investing, it's a gamble disguised by stories. Speculation is like betting on roulette spins, random and fleeting, whereas a coherent investment program is playing chess, making moves grounded in analysis and logic. Klarman's criticism cuts deep. Many chase instant wealth but ignore foundational principles, treating markets like casinos rather than forests of real companies. His solution, a clear, repeatable blueprint driven by discipline, patience, and skepticism. He advises focusing only on securities priced way below intrinsic value, ignoring noise, and never overpaying. This method isn't flashy or fast, but over decades it consistently beats the speculators and hypes, building wealth quietly but surely. Back in '77, Klarman's quiet hunt for bargains felt like swimming upstream, and that's exactly why it worked. The market's noise fades when you zero in on real value and keep a margin of safety protecting your bets. Next time you're tempted to chase the hottest fad, try this. Ask yourself what the asset is really worth and never buy without a safety net beneath you. That's your investing edge. Subscribe for more book summaries like this one.